The stock of the morning, if you could call it that. DCB Bank 15% higher now after its results. The second quarter, good one. Credit costs were down, the margins expanded. Mr. Praveen Kutty, the managing director and the CEO of DCB Bank, is now joining in. Mr. Kutty, good morning. Thank you so much for joining in and wishing you, your team, your family a very, very happy Diwali. First up, your credit costs have seen a significant improvement.
Thank you for having me here.
Your credit costs, they have seen a very significant improvement, right, from the previous base quarter. Do you see that trend improving? Was there a one-off that led to this improvement in credit costs, or do you see this trend being normalized in the second half as well? Where do you see them by the end of the year?
So what we are seeing now is a series of quarters where our growth has been consistent. And last quarter, our credit cost was 0.59%. And I had said that at that point in itself, that's a one-off. We are being prudent and we are taking up increased provision for the unsecured portion in our books, primarily comprising of MFIs. Now that's done, we are back to normal. And I remember telling you last time itself that for the full year, we would be less than 0.45. And if you were to look at the last half year, the current 31 bips credit cost and the previous quarter 59 bips credit cost, we are still at the 45 bips mark. And my guess is that we will end the year in the early 40s, if not 40.
Okay, that's about the credit cost. There's been an improvement in net interest margin as well to the tune of 3 basis points. How will NIM shape up from here on? It'll reach that 3.5% mark by FY26?
The way I see this is that across the bank, over the last 5-6 quarters, we have gone ahead and tightened our belt. And that's true in cost of deposit, that is true in cost of borrowing, that is true in cost, OPEX by itself, and we'll talk about that at some point in time. I really felt that we were leaving too much on the table on multiple parameters, but we've significantly tightened stuff. And the repo rate cut, a 100 basis point repo rate cut, has been a blessing in disguise because it helped us cut the flab, make us leaner, look at every opportunity of cutting flab. And I think we're seeing the beginnings of that. The bank has grown 19% on deposit, 18.79% on deposit YOY, with a much tighter cost of deposit coming through. And that is a change not only for the quarter, but I wouldn't say it's cultural yet, but if you see 2 or 3 more quarters of a similar kind of growth coming in with similar kind of tight cost of funds coming through, then possibly we have a good thing going in the future. But I can confidently say that the NIMs have, the bottoming out of the NIM has happened. So from here on, unless there's another rate cut, we would tend to see a NIM expansion happening.
And unless there is a rate cut, what could be the extent of NIM expansion over the next 2 quarters? You're at 3.26, I think, now.
So we're at 3.23 right now, which is at 3 basis points higher than the last quarter. And I'll tell you how it works. Our term deposit usually is of a 15-month duration. So with every passing month, the deposits that we have booked 14, 15, 13 months back is coming up for renewal, and you're getting the benefit of a significant amount of benefit because the new term deposits are being priced at a much lower rate than the old one. So even if you were our renewal ratios continue to be as it is, and there is, let's assume there's no improvement, we would see a significant decrease in our cost of deposit by virtually doing nothing, just by renewing our existing deposits.
Now, Mr. Kutty, your cost-to-income ratio, it's inched up slightly during this quarter. If you could shed some more light on that. And is it only because of the lower base, on the back of some muted other income? Do you believe that this will normalize in the second half?
I look more at cost to average assets than I look at cost to income. But since you asked about cost to income, it's pertinent to point out that between Q1 of this year and Q1 of last year, we shaved off 700 bips in last Q1. And in this Q1, where there's been an uptick and we are at 61% plus, we have shaved off 300 basis points. So if you were to compare it where we were 12 months back and now, both across Q1 and Q2, there has been a significant cutting down in cost-to-income ratio. Now let's look at cost-to-average assets for a change. It was 2.75 5 quarters back, went down to 2.65, 2.54, 2.52, and now we're at 2.43. And this is like consecutive. Every consecutive quarter, we've been lesser than the previous quarter. So we shaved off 32 basis points on cost-to-average assets in the last 5 quarters and last 5 successive quarters. So that's a trend. That's not a one-off. And that's why I said there is a bit more of fiscal discipline. There's a bit of tightening of belt across the various units of the bank. Yields have gone up, have been tightened. We have let go of borrowings which are expensive. We let go of investments which are poor returns. And on OPEX, we have seen that we have reduced 1,118 people in this year, from last year to now, and we've still grown 19%. And you also see that technology adoption has been significantly higher, which is helping us in our OPEX cost. So these are not one-offs. These are I would tend to think these are cultural shifts. These are tech adoptions, and that would keep the bank in good stead in the coming days. We haven't seen the full impact of all we have done so far. We just scratched the surface. Much more to come.
Got it. Mr. Kutty, last question before we let you go. Quickly, if you can tell us what is the target on loan growth and which segments are driving loan growth for you?
Yeah. So we want to keep it between 18 to 20% growth, which is the way we've been growing for the last 5 quarters. You would see similar kind of growth happening. The sectors, frankly, nothing new. SME is a very important component. Mortgages is important. Within mortgages, LAP will overshadow home loans. You see gold loan, organic gold loan increasing as we go along. The only area where you would perhaps find a reduction in a percentage terms would be co-lending. Q4, you would find that our co-lending ratios will come down. We are at 16% plus currently. By the time the financial year ends, it will be 15% or less. But except for that, I think every other asset category, you would see the normal kind of growth that you've been seeing for the last 4-5 quarters continuing.
Thank you very much for that. That is DCB Bank guiding for an 18 to 20% loan growth. They expect the NIMs to improve from here on in Q3 and Q4 unless there is a rate cut. So the management categorically saying they have bottomed out. And even the credit cost, which in the first half of the year was 45 basis points, towards the end of the year, it could end closer to 40 basis points or between 40 and 45 basis points. I think that explains why the stock is up nearly 15%. Get into a break. On the other side, we'll focus on the crypto market. Manisha Gupta joins in.